Welcome to Street Check, the greatest podcast in the history of Cabot Wealth Network, which has been doing business since 1970. We've been delivering investment insight, ideas, research, stock picks for more than half a century. I'm Chris Preston, editor-in-chief and chief analyst of Cabot Stock of the Week.
I'm Brad Simmerman, web editor and chief analyst of Cabot Wealth Daily. Today in our big three, we are going to start with macro events, jobs, inflation, the Fed, and the recent market bounce back. Then we'll move on to the surprise run in cannabis stocks on the heels of a descheduling recommendation from HHS. And then we're going to wrap up the big three with a sort of a repeat of last week, a conversation about a high-flying SPAC that sort of bit the dust and for interesting reasons. And then after that, we're going to go ahead and celebrate our producer Madison's due date by covering a handful of baby stocks. And we're going to get her take on which have the sort of best enduring value as a new parent, or maybe which are the most attractive for investors.
Yes, and she is due today, which is why this is timely, and hopefully we can make it through this. If we suddenly go dark, you'll know why, because Madison went into labor. But yeah, and so we will lead off, Brad, as always, with the Defend the Take, and you're up this week. And your take is, for which you have 90 seconds, is 40. You believe that 40-year mortgages will become available to U.S. buyers soon. Again, you have 90 seconds. Go.
So HSBC Bank in UK just rolled out a 40-year mortgage option for borrowers there. They did so because housing unaffordability is even worse in the UK than it is here. The median home price in the UK is 9 times annual median earnings or annual median income versus the US, where it's 8 times median annual income. A 40-year mortgage also lets you stretch those higher rates. You can go for a lower rate over a longer term, which reduces your sort of monthly out of pocket. We've never really formally had 40-year mortgages in the US. We do have a framework for collateralizing them, though. The FHA has a loan recovery program that allows lenders to restructure distressed mortgages for borrowers from 30 years to 40 years as part of rehabilitation efforts, essentially. So we already have a little bit of an infrastructure for that. Now, those don't trade as mortgage-backed securities like most mortgages do. Those are held in a separate account with FHA. It's held in a different place on their books. But we're in a period with really bad housing unaffordability. We're essentially at the same levels that we were at before the great financial crisis and the housing meltdown. Borrowers are getting cash strapped. People are dipping into savings more. I expect that 40-year mortgages will roll out. They seem to be a very reasonable and appropriate sort of policy measure without fundamentally changing how we borrow money around homes.
There you go. You hit the post.
Now, I will.
What's that?
I was going to say, I'll caveat that I don't know if soon is really when we're going to see it, but for the sake of establishing stakes, yes, before the next time we have to pay for our bad takes, I will say we'll see a 40-year mortgage being offered by a major lender in the U.S.
Okay, so roughly within the next year, although we'll see how many bad takes we have. We may have to bring in the hot sauce sooner than expected. Yeah, this is a good piggyback onto last week's conversation with Nancy Zambell about housing. Yeah, 40 years sounds crazy, but you may be right that that's going to become a necessity given home prices, given interest rates right now. I was surprised to learn, honestly, you said in the UK they've.
Yeah, HSBC Bank just rolled some out like 2 days ago. I mean, if you think about it, it's not really that consequential insofar as the average mortgage only lasts 7 years. So that's the life of the average mortgage. The average mortgage is either paid off and, through a housing sale, and then there's a subsequent purchase, or it's refinanced within 7 years. So whether you're at a 40-year mortgage or a 30-year mortgage, the only real impact, the only material impact is how much you're paying out of pocket each month and how quickly you're building equity. But from a structural standpoint, it doesn't really increase risk for banks. It's not really this really bad overhang for a borrower to be in a 40-year loan, because refinancing is an option, selling the property is an option. So I think it'll be good news for maybe borrower flexibility, and it would offer maybe a little bit of a window for us to get out of the golden cage that we're stuck in with low rates, like we talked about with Nancy. So I think it'll improve borrower flexibility, but I won't really have a material impact on lending market or risk or anything like that.
Okay. All right, let's move on to our big three. I'll start with number one. The market has bounced back since bottoming. S&P bottomed around in mid-August, I think August 14th. It was in the mid 3,300s. Didn't quite get down 5% on a closing basis, Brad. So my take that it would not for the rest of the year is still safe for now. There, we're actually up 3.3% since then, and we're getting close or within, as Tom Hutchinson likes to say, bad breath distance of the yearly high. Not the all-time high, but is this, and a lot of the gains have come this week. What's helped has been the signs of the economy is cooling. 3.8% unemployment rate reported just this morning, highest since I believe February of last year. GDP revised down in the second quarter from 2.4% to 2.1%. And also bond yields are coming down too. That has helped. Is this a real? The real test will come next week, as we've been saying for weeks, that after Labor Day, when Wall Street's fully back in gear. September is notoriously the worst month on the investment calendar because institutional investors come back from their vacations and they sell off their laggards from the summer. Seems like there's been more engagement this summer, though, and I think you mentioned just offline to me, it seems like a lot of the selling may have already happened in August. So how much credence do we give to what's happened the last couple of weeks, the turnaround that's happened the last couple of weeks? Do you think the real test will come in the next couple of weeks, or do you think there's some real momentum here that'll carry over?
So I want to pull back to something you said in April, right? Which is sell in May and go away, right? That's not in play this year. There's structural not defects, structural strengths in the market, or structural reasons in the market that seasonality is not applying. I think that could be the case in September as well. I'm not going to be so bold as to say that it's not going to be the worst month. I mean, historically it is, but there's a ton of money on the sidelines. There's less impetus to sell underperformers if you already sold your underperformers in December or January and you're not really holding them and you're holding a lot of cash. I don't see where maybe a surprise comes from, right? Like we've been saying, I've been saying take the Fed at their word. We're seeing this sort of soft landing scenario play out where inflation is still elevated, right? It was 3.3% was core PCE in July versus expected of 3.1%. So it's a little bit higher than expected, but we're expecting it to stick around, and it's going to be a little bit lumpy on a month-to-month basis. But as long as the overall trend is heading in the right direction, I don't think that's cause for concern. By that same token, maybe the Fed hikes rates again, but job numbers are improving, GDP growth slowing, right? All of these are criteria that we would look to as being as being unexpected surprises that could change the narrative. And I don't see it. So I think you can make a case that we can maybe disregard September's historical month as being, or historical performance as being, the worst month in the year. And, maybe we do get a little bit of selling. I think you had said something in the neighborhood of the first couple of weeks of September might be like a feasible timeline for us to see a little bit of back to the office, back to the trading desk selling, before we just sort of run out of steam there.
Yeah, especially given how strong the gains have been this week. I didn't expect the market to do much this week, just
Yeah.
given the low volume, but it's been a good week on lower than normal volume, or not lower, perfectly normal for this time of year, but lower than
Seasonally low volume.
Yeah. So I would expect just the market to pull back next week, but I could see the real turnaround beginning second half of September. I kind of figured it might around then anyway, just giving the usual timeline of corrections after a big run up in the market. Will we go below the mid-August low? We'll see. But it's possible the bottom has already been put in. I'm sure a lot will depend on data, especially the inflation number coming in the first half of the month, the other inflation number. I think the next 2 weeks will be really telling. Like I said, I would think next week would be down. How much down? We'll see.
Yeah, I don't think it needs to prevent if somebody's looking at like investing or looking at maybe allocating a portion of their portfolio into something. I don't think that just the fact that we're in September now should necessarily be a hindrance. I think you can still sort of comfortably buy the current bull market, even if we see a little choppiness ahead.
Yep. Okay. Move on to number 2. Cannabis is a subject that we have not discussed a whole lot lately because it's been one of the worst sectors in the market. I mean, the industry, the cannabis index is down, what, like
80%?
Yeah, something like that in the last, I think the top was like February 2021. So like 2.5+ years of nothing but down. And there's been false starts before and just pulls right back. Well, I just got one of the biggest spikes we've seen, I think, since late 2021, November. No, maybe it was last November. This week on, as you mentioned at the top, Brad, the Department of Health and Human Services, HHS, recommending reclassifying cannabis use as lower risk from Schedule 1, where it's grouped with heroin, LSD, others seems very outdated, to Schedule 3, and it'll go to the DEA for review. So the MJ, the ETF that tracks the sector, is up 21% in just the last 10 days since then. And MSOX, which is like a leveraged fund that goes to anywhere from 2 to 4 times in both directions what the index itself is doing, had like 2 straight days of 40% gains. And so we have a Cabot Cannabis investor newsletter. It's been a bit of our redheaded stepchild. We haven't mentioned it a whole lot, even though it's run by a very capable analyst, Michael Brush, who byline you've seen in Market Watch and other places over the years. He has MSOX in there. He has MSOX exposure, and he's been hammering the table about that, pounding the table about that. And so if you're one of the lucky investors or subscribers who's hung in there with him, you got rewarded the last few days. Do you think, Brad, that how much can we believe in this mini rally? Is this HHS decision the catalyst to get the industry finally off of its knees, or the sector finally off its knees, or did you need to see more?
I mean, the problem with anytime you add politics to it or policy making to it is it sort of has to matriculate through the system. A couple of items for context. MSOX, which is designed to double the return of the ETF MSOS, so it's intended to outperform double in either direction, up 86% in the last week. MSOS up 40% in the last week. The highest 1 week returns we've seen since that February 21 top was in November, when we saw a 14% run up over a 1 week span. So this definitely dwarfs it. The descheduling to Schedule 3 would potentially open these cannabis businesses up to more tax benefits, the ability to sort of write off their expenses, which will go directly to bottom lines. But the concern is still larger industry trends, right? There's still ongoing price compression. Wholesale prices have come down a lot because of oversupply. And there's individual company performance, right? A Green Thumb or somebody might not survive it, right? I'm not saying that Green Thumb specifically won't, but if you pick out an individual cannabis name, it's still a really tough industry to operate in. Once we get that descheduling completed, I think that's sort of the green flag, full speed ahead, invest, in whatever of the companies you like best. But until then, you're still navigating a lot of speculation around what the legal picture is going to look like, how quickly the legal picture could change. I have seen commentary that the HHS recommendation, now that that's in, the rescheduling process could move much faster than people are expecting. So maybe even by year end, we could see it descheduled. But then that's where companies are competing on their merits instead of just getting a reprieve for the industry as a whole. So it's definitely bullish news. The prices were so depressed after, as you said, almost 2.5 years or more than 2.5 years now of a bear market for cannabis stocks. So I would probably be targeting cannabis companies with low debt or relatively low debt and lots of cash on hand, because they're more likely to be the acquirers than the acquirees. Because keep in mind, cannabis companies with a lot of debt have accumulated that debt in periods of really low interest rates. So when they have to refinance that, when you start seeing maturities come through, that's going to be happening at much higher interest rates. That'll be a difficult ocean to navigate.
Yeah, and like you said, if you're a bit queasy, investing in picking one or two of these companies makes you a bit queasy. Those funds that we mentioned are a good way, more of a catch-all to capture the gains. If you're wanting a bit lower risk, MSOS, like you said, Brad, up 40% in the last few days is a good way to go. But if you want the higher upside, MSOX, which is 2 times plus, the MSOS up 86% in the last few days. That's another way to go. But the reverse of that is that also has more downside, twice the downside. And like I said, Cabot Cannabis Investor has both. And if you're wanting some advice on what stocks to buy or how to play this rally, that is the place to go. It's under the premium advisories page on the cabotwealth.com website.
Yeah, one thing that we had sort of speculated about off air regarding the cannabis stocks is the AI growth stock rally. It definitely feels like it's getting long in the tooth. We saw Nvidia struggle after their earnings.
Yep.
If we're in a rolling bull market, like I think Jacob had written about, which is the flip side of the rolling recession that Bruce had talked about, if that's the kind of environment that we're in, growth stock buyers are going to be looking for the next sector. There's definitely potential that cannabis could be a short-term beneficiary of that rolling bull market, even if maybe it gets a little bit overheated and then corrects down before we get definitive and concrete rescheduling news out of Washington.
Yeah, definitely the definition of a buy low candidate. And now it actually has a catalyst for the first time in a long time.
Yeah, and one last item for context, MSOS is down 70% in the last 5 years, even off the most recent rally. So it's not like prices are super overheated at the levels that they're at right now. They've just gone from absolute bare bones to a little bit of meat on the bone.
Yeah, it's more that there's been a lot of false starts with the industry or with the sector over the last couple of years, but usually the starts have not. I don't know if any of the starts have been as decisive as this one in terms of a quick run up.
No, and not as well funded or not as well founded either, right? All the other false starts have been on speculation about maybe getting safe banking through, maybe getting federal decriminalization. This is concrete evidence that the sector's making progress and is much more meaningful than anything we've seen in the last 2 years.
All right, that's the most I've talked about cannabis living in Vermont in at least a day. Okay, so number three, you mentioned SPACs. There's one IPO SPAC, VinFast. That well, I'll let you go on this one. This was your baby.
So VinFast is it's a Vietnamese EV company that went public via a SPAC on August 15th. It started trading at 24 a share and rose to 37 a share on the day. By Monday, the 28th, shares had risen to over $80 a share. Since then, they're down 67%, trading at 27.31. So very, very near the SPAC price. The reason that I wanted to flag this one is it's nearly identical to what we talked about with Better, where these market structure deficiencies are undercutting what, maybe could be a viable company. Now, to be fair, VinFast has sold somewhere in the neighborhood of 11,000 vehicles globally and less than 1,000 in the US. For context, there's estimated to be about 50,000 Model T Fords that are roadworthy and on the streets in the US. So, you think about that, it's like a hobbyist kind of auto, and it's still 60 times what VinFast has on the US roads.
Yeah. But the 11,000 number globally, that's pretty small too.
Yeah, you could make that by hand. If you and I wanted to go make a handmade EV company, we could probably produce 11,000 vehicles a year. But
our next segment. Oh, sorry.
So one of the reasons that I wanted to bring it up is the weird ownership structure of it. It's largely owned just by the founder, and that's through him individually, and then also through 3 holding companies. He owns 99% of the stock that's outstanding. So that's such a structural deficiency in the share price that you can't actually look at the share price as being at all indicative of the company's value. If you're, if you're interested in investing and you're seeing news reports about this company coming public with a market cap higher than Ford and GM, you need to you see that and you think, oh wow, this must be some hot new technology company, this hot new EV company that I have to have. They must have some like groundbreaking technology. But no, what it actually is it's one person owns all the shares. If I own all the shares of Brad's stock, and I say I've got 1 million of them and they're $100 a share, I'm not worth $100 million. You can sort of take that same approach with this SPAC company. I do think that it's more evidence that SPACs were, because they were less subject to regulatory oversight before coming public, they're fundamentally higher risk. We talked about it last week. I think you got to be very wary investing in any SPACs. And with this as a perfect example, take some of these headlines that you see with a grain of salt and maybe do a little bit of deep dive and a little bit more research. As far as like whether VinFast is tradable, no, you cannot buy shares. It's got a market cap of 63 billion right now. It's only lost money. Completely ignore share price. And like I said, that's the only real like data input that we have as far as whether the stock is gaining momentum or losing momentum. Ignore it until there's some sort of secondary offering where he takes a bunch of these shares and they enter the public markets, and then we'll get a market consensus for what this company's actually worth. But until then, definitely stay away from this company.
Yeah, SPACs to me are similar to meme stocks. They're only become relevant in a super frothy market and near the top of that market, and then they crumble. I don't know if that'll happen again at the tail end of this bull market, but certainly not happening now, as we're seeing with this one.
Well, the crumbling part is happening now, but
I mean, remember how SPAC?
Yes.
A lot of our analysts were talking about SPACs, or were recommending certain SPACs and talking about them as a viable investment vehicle for, what was it? A couple of years ago, a year and a half ago, even. And everyone was.
Yeah.
And now, that seems like it was just a mirage, really.
Well, the trust redemption value was a good thing for individual investors. We talked about Better last week. Individual investors largely got out of that unscathed, right?
Yeah.
Like you're participating at $10 a share, and then you end up withdrawing your SPAC money when it's at 10.10 because they've delayed the deal offering by a month and have to pay you an extra dime. So there was sort of an escape hatch for individual investors, but the speculators are the ones that are getting burned lately. The speculators in Better, the speculators in VinFast. It should be probably a lesson to all of us that the speculative stuff is where you start taking on more risk than is maybe appropriate. Look for earnings. Look for companies that are well run. Don't follow the hype.
Yeah. Okay, let's move on to babies. Madison, are you still with us?
We all have them. We all love them.
I'm here.
Babies.
Yeah.
We're not in labor yet. We're
Not
good.
in labor yet. Okay. Yeah. Madison Robertson, our producer. Today is your due date. Is that correct?
Today is the due date, which is why I'm going to stay off camera. If
Yep.
that's fine
Very
with you
understandable.
all.
Yeah.
Thank you.
Yeah. Just in case something happens. How are you feeling?
Tired. She's definitely positioned in some way where she likes to hang out and kick my bladder a lot. So I spent a lot of my sleep time taking bathroom breaks. I'm
It's
a little
always
sleepy today.
It's always bladder or ribs. You catch a
Yeah.
foot in one of those two spots.
She's been staying in a very 90-degree angle kind of way. So she's kept her feet like right at my side and just will give a couple kicks whenever she feels like it. We're gonna have a long conversation when she gets out of there.
Well, I'm
Hopefully that's
excited
good.
for you.
Yeah.
Hopefully it goes well for you. Hopefully, as soon as we wrap this podcast, you are in labor, nice and easy, and then you're home before the long holiday weekend with a new baby.
That's the
This will definitely be your
plan.
last episode with us for at least 3 months. Correct. Yeah.
I think so.
Yeah.
Oh my gosh, if she waits till longer than next Friday, we're gonna have a real
Oh no, we
problem.
won't even put you through that. We wouldn't have you. We'll have Sam come on for this
Yes.
next week. No, yeah. Okay, so in your honor, Brad and I selected 3 baby industry related stocks that we both like. And at the end, Madison, you can tell us which of these companies, you don't have to talk about the stocks or anything, but which of these companies sound like ones that you will use, have used, are using, if that makes sense.
Yeah, sounds good to me.
So before we get started, my list, I decided to go with a sort of enduring baby brands, right? Anybody that's had kids knows how quickly things come in and out of fashion. It's, the Lewis Black, the comedian, had a joke about whether or not eggs are good for you because we keep getting new information every year. It feels like the same thing with anything kid related. It's like, oh, do you swaddle them? Yeah. It's like, oh no, that'll kill them. You can't swaddle them. It's like, oh, they sleep on their stomach. No, you got to sleep on the back. And then this stuff goes back and forth. So my hope was to identify these enduring legacy brands that sort of, no matter what comes, these are brands that are going to stick around. What was your overall approach, Chris, coming into this?
Companies that we used a lot when our kids were babies and still use, frankly. Well, in some cases, that our friends use a lot, that everyone we know uses a lot. And then also there were some that we used a lot. I looked at their charts and they were horrible. Not all of these are public. The companies that came to mind were public. So I eliminated some of those. So this is sort of a combination of stock performance, at least to a degree, and just usefulness, at least from my perspective. So
Okay.
I'll let you kick it off.
All right. My first one that I went with is Newell Rubbermaid. They manufactured the Graco brand of products, which is essentially like it's the consumer equivalent of Default. Where it's like if you see a stroller on the street, there's a better than 50% chance that it's a Graco stroller. If
What's the ticker
you're
symbol? Sorry.
for Newell Rubbermaid, it's NWL.
Right. Cool. Yeah.
Now,
I did look at that one. Yeah.
so they also manufacture the Rubbermaid family of products. They make a ton of consumer and commercial products. The reason that I selected it is just because the company's been around for 50 years. They've been world beaters at times. That's certainly not the case right now. They're currently trading at February of 2009 levels. Market cap's 4.3 billion, and they're offering a 2.65% dividend yield.
Revenue is expected to be down 12% this year, but that is
Yes.
something that we too use. Graco. Yeah. Good brand.
But the other one of the biggest concern with it is debt load. Debt load is really significant. Management has addressed it. They're at about six times, what is it? 6 times revenues worth of debt, and they're looking to get that down to 2.5 times. It'll be a long process, but the Graco default status, I think, even if some of their other business units are underperforming, I mean, that'll obviously impact the overall performance of the stock. But this feels like one that you could just park in your portfolio. It's probably not going to outperform the S&P over a 10 or a 20-year time frame. But if you get it in the right time in the cycle, it could lead to some overperformance while you collect a reasonable dividend yield with relatively low risk of the company going out of business or becoming a total loss. I mean, it's down 39% in the last year. It's down 50% in the last 5. In the last 50 years, it's returned 36%. So you're right around 7% a year. It's underperformed the S&P, but it's an enduring brand at least, and I think it's a reasonable holding. But I certainly wouldn't plow my entire portfolio into it.
My first stock is Amazon. It's up 63% this year. We use it all the time. We used it then. We use it now. I'm not sure there's a night that goes by when my wife's not looking for some sort of kid-related product on there. It's obviously Amazon is used for many things, not just baby-related products. Just going on Madison's baby registry, I think most of the links went to Amazon. They've cornered the market on baby products, or at least many of them. And it's a good company that I think will be around for a long while. And I think baby products will be part of that brand for a long time. So Amazon, there's my first pick.
Well, I do like that pick also leans into the fact that, like, oh, you have a baby, you're not doing anything. The only way you get a product into your house is if somebody brings it to you. You do not have time to shop. You don't.
Yeah.
It's like, oh God, I'm out of outlet plugs. I can't go to the store because I've got this baby I'm dealing with who's colicky or can't sleep or whatever. Just okay, open up Amazon, fire off the order.
Right. Yep. There you go. That's my first.
My second pick, another sort of enduring brand, is Carter's Inc. They are the baby clothes manufacturer that also operates Oshkosh B'gosh, and it sells products through both its own Carter's stores and the Oshkosh B'gosh retail stores. Company was founded in 1865 by a gentleman named William Carter. The Carter's brand of baby clothes was our go-to. The added benefit, if you are a baby clothes manufacturer, is that babies grow really fast. So if you get a cute design that you like in the 6-week size, you got to go back in 2 weeks later to buy the 2-month size, and then a month after that to buy the 3-month size. Company trades at 13 times trailing earnings, pays a dividend of 4.21%. This one, technically, it is in a downtrend,
down 4% year to date, but seems like it's up.
Yeah, and down 1% down 3% the last full year. Lows for it were in May, June. It's bounced since then and is technically in an intermediate term uptrend despite being slightly lower for the year. But that seems like another one that it's like, hey, valuation is good, dividend yield is relatively high, and the company is strong and it's a respected brand. So that would be pick 2 for me.
Okay. My number 2 is Procter and Gamble, another big name. Dividend stock, one of the best dividend payers and growers. I think it's a dividend aristocrat, 2.4% current yield. It is the maker of many products, but included among them are Pampers, which is the number 2 brand, just narrowly. 2022 is just narrowly behind, I think, Huggies, which I think is part of what your third pick is going to be, I think. It also makes Loves and All Good, which is not product from, I think that was after our kids were babies. I think it started in 2020. And Loves are also they also have baby wipes, which we use. I can still see the label. I feel like you still have Loves baby wipes sitting around somewhere. If you just like open up a closet, there's fallout. So everyone needs diapers. Everyone needs baby wipes, and Procter and Gamble is a huge maker of both. And everyone knows the Pampers brand stock. As for the stock, and again, it obviously makes a whole lot of other products. It is up 1.5% year to date. It's in an uptrend. First bottom was in March, then bottom again in early June, but it's up quite a bit from 142 to 154 since then. And it's just steady. It'll churn out a gain just about every year. Last 5 years up more than 80%. It's not necessarily a market beater, but just a classic reliable dividend stock. It's going to be around for a while, has been around for a while, will be around for a while. My grandfather gifted me Procter and Gamble shares, I think, when I got married, and it ended up just with the drip that he enrolled me in, the dividend reinvestment program. We were able to help sell the stock and use it to help pay for our first down payment on a house. So it's a good dividend stock that'll keep churning out gains every year, and it makes a lot of good baby products.
Yeah, as you alluded to, I went sort of a similar direction. Kimberly-Clark, KMB. They are the manufacturer of the Huggies diapers. My rationale is largely the same, although the long-term performance for Kimberly-Clark hasn't been quite attractive. It's up 10% only in the last 5 years. It's down 1% in the last year, which, it should have comparable performance to Procter and Gamble in a given year, right? Just because they're in the consumer staples sector. They are in similar lines of business. Kimberly-Clark, though, trading at 26 times trailing earnings, but only 20 times forward earnings. So not a particularly challenging valuation, but not exactly a discount. Dividend yield of 3.71%, though, is very attractive. Less so in an environment where you can get 4% from a T-bill. But enduring brand, once you've had some loyalty to a product, you tend to stick with it as a new parent, because so much is new and so much is uncertain that once you can lock something in, you're really committed. So you're going to have a brand loyalty to things like diapers, formula. I like the dividend yield. It's another one you could just park in your portfolio for the next decade, and you'll collect some decent dividend checks, and maybe you'll get more than you would get in the sort of average S&P dividend, but at lower performance. But again, enduring brands. I also ran RBGLY. They are the British company Reckitt Benckiser. Benckiser. They go by Reckitt. They own Mead Johnson, which manufactures the Enfamil brand of formula. The reason I had them as an also ran is just what I was talking about with that brand loyalty thing. Once you're locked into a brand of formula, you stick with it. I can't really endorse it fully, because I really don't want anything to do with the British Isles right now, given that they're facing record inflation and even higher interest rates than us. and given all this all the post-Brexit hardship they've encountered. So I can't fully endorse it, but also ran. Did you have anything that you were looking at as?
Yep. My third one is a little bit more under the radar than the first two. It is ticker symbol CODI, C-O-D-I, company name Compass Diversified. They make Ergo Baby carriers. We use them a lot. It's basically, you strap your baby in right in front of you, and you walk around with the baby facing out, and it's a pretty adorable look, and sort of a how I remember, the only way I remember seeing my wife walk around outside the house for the first for about 3 years when both our kids took turns being babies. And it's a good stock. It is, at least this year it is, it's up 15% year to date. 4.8% dividend yield. I don't know exactly how sustainable that yield is, but it does pay a nice dividend. Let's see, it trades at 13 times forward earnings, so not bad. Price to sales only 0.64, and then it is expecting sales growth minus 1.2% this year, but then up 8% next year. So yeah, they're makers of Ergo Baby. They're small cap stock, $1.5 billion market cap. And, these are, if Madison, I assume that if you don't use this, once you have your baby, I'm sure you will see other people using it. It's a very useful way to get around with a baby.
Oh yeah, we got one of those, which was really a huge gift, because the other kind of carrier we got was that one of those the boba or whatever they're called, the wrap things where you have to really maneuver the extra long scarf around your body.
Remember that brand? That is so hard.
It is boba. My wife swore by them. That would have been one of my picks if they were not a privately held company. And the other issue, like you bring up the Amazon thing, like how hard is it to replace a big string of fabric that you wrap around your body with like that doesn't have any barrier to entry at all. I will say that was my wife's preference, was that boba wrap over the front facing carrier, because you can just fold it up and toss it in a purse. You don't have to carry the carrier around if the baby's out of it, and you can just sort of have it on all day without it making you all sweaty and hot because you've got that big thick carrier. So I would fully endorse that one. Recommend learning how to use it.
All right, Madison, which of the 6 that we gave do you gravitate towards,
or which brands, at least?
Brands, yeah.
Okay, I thought Carter's was a real good one, because we found some really cute and very cheap outfits from them, and they need to be cheap because we're not spending $1 million on clothes she's going to grow out of in a couple months. Rubbermaid, I thought, was a big one, because Graco, this is going to make us sound a lot more crunchier than we are, but they have a lot of Green Guard Gold certified cribs. So we got one of their cribs, which is just a like toxin-free, chemical-free, whatever kind of crib. So we're a big fan of them. And then obviously Amazon. Amazon's made our registry, that whole thing, so easy, especially with our family being in another state. It's been awesome.
Yeah. Amazon really does make life easier, especially when you are a parent of young children, as I'm sure you'll find out hopefully within hours.
Hopefully yeah. Well, and even to that point, like I have a whole list, because there were things we knew that we didn't need right away with her. So I've got a baby list already started on our Amazon account of, okay, when she hits 6 months and starts eating solids or whatever,
right.
They've made it real easy to make some sort of plan when it comes to babies.
Yeah. And I think I mentioned Procter and Gamble is, the diaper maker of Pampers, but I think we ordered a lot of our diapers just through Amazon. Is that what you did, Brett? I think that's my recollection of it, at least.
Nah, my kid, so I think my kids are a couple of years older than yours. At that time, I don't like Prime delivery wasn't really a
Yeah.
thing, so you had to pay for shipping.
Right.
We would just buy the biggest box we could, either at Fry's or whatever, or if we occasionally went to Costco.
We did some of that too. Yeah. Yeah. When you needed it quicker, of course.
The tough thing was always when they grew out of a diaper size, when you bought the 120 count box and you'd gone through 30 of them, and then they're out of the diaper size, and then you've got like 4 bags.
Yeah.
Like, all right, well, I'll just take them into daycare.
Yeah.
And
right.
just give them away or give them to the doctor's office or whatever.
Yeah. There's a lot of diaper drives around here that people had a lot to donate to. Well, Madison, I really hope everything goes smoothly and soon. I'm sure that's something you'd agree with.
Yeah, according to plan, she's got a timeline, she's got to stick to it.
Right. She wanted to wait till she wanted to hear what Brad and I, 2 men, had to say about the baby industry before she was ready to go.
If she comes out a stock person, it's going to be your fault.
Yeah.
She's going to say she listened to Stock Calls in the Womb, Stock Podcast.
Didn't work on my kids, so if she comes out a stock person, I think it falls on Chris.
Okay.
Unlike Jacob's kids, my kids do not care.
Yeah, mine are too young. Well, Madison, good luck, and
we'll miss you.
We will not see you on here next week, no matter what, and we won't see you on here for 3 months. But we hope to see everyone else back here next Friday.
We promise not to burn any of our good content while you're gone. We'll save it all for when you come back, so Sam just gets the dregs.
Perfect. Yeah. I was going to request that, and to not explode overnight yet. Wait until December to really get into the millions for your follower count.
Okay. Yeah. Well,
I'll hold off. Yeah.
Thanks.
Yeah. Speaking of which, if you are listening or watching on YouTube, hit that like button, subscribe, 5-star rating, everything. Again, we don't ask you for much. Just please do that.
Like, share, email us, streetcheck@cabotwealth.com with questions, comments, feedback. We are all ears. We're welcoming it. So if you have anything, let us know.
Great. And we will see you next week.
Bye.